Everybody, welcome. We're going to learn today about inventory costing methods. So we have several different methods for determining our cost of goods sold. And these are going to be FIFO, which is first in, first out, meaning that the first goods in our inventory are going to be the first ones that are going to be expensed to cost of goods sold. LIFO, last in, first out. The last goods in our inventory are going to be the first that are going to be expensed to cost of goods sold. Weighted average, we take an average of our inventory costs. We then multiply that by the units sold. That's going to determine our cost of goods sold. Specific identification is going to be used for a jeweler where we have unique items that are being sold, and we're specifically assigning those costs to an item that's being sold. I am not covering specific identification in this video. If you really want me to do it, send me a message. So the other thing we're going to be looking at within those three different methods, there's also two different assumptions. One is periodic, one is perpetual. Periodic assumes that all sales happened at the end of the period. We disregard the dates of sale and assume that all sales happen at the end of the period. Perpetual assigns cost of goods sold chronologically by sale date. We go to the first sale date. We look at what's in our inventory. We go ahead and assign to cost of goods sold based on that. Now, what we're going to be going through and doing is we're going to be covering 5 methods, right? There's really 3 and then 2 on top of that. But right over here, we're going to be looking at FIFO periodic. We're going to look at LIFO periodic. We're going to look at weighted average periodic. We're then going to look at LIFO perpetual. Then we will be looking at weighted average perpetual. We are not going to do FIFO perpetual because the results are exactly the same as FIFO periodic. So over here, we're going to cover 3 periodic methods and 2 perpetual methods. Again, the goal of these methods is how do we assign costs from inventory to cost of goods sold. Now, as we're going through and doing this, what we're going to do is I've got an example already and teed up for us to go through and do. It's going to be a lot of fun. But the first thing we're going to do, I'm going to do a separate video on this because it is so important. The first thing we're going to do is we're going to do the constants. The reason why we're going to do the constants is because these values are the same for all of the 5 methods that we just looked at. These are goods available for sale, or the cost of my beginning inventory plus my purchases during the period. My units available for sale, my beginning inventory plus all my purchases in units during the period. My units sold, how many units did I sell in total? And lastly, my units and ending inventory. That's going to be the difference between the units available for sale minus the units sold. The last one is going to be total sales in dollars. We're going to use it once, but not again. So that's kind of more of a throwaway number, but I do ask it on my tests. So I want to thank you. Please leave any questions that you have below, and appreciate you liking and subscribing to these videos. If there's anything else you want to see, like specific identification, feel free to ask, and I look forward to seeing you on the next video. Have a great day.